I'm going to give some very contrived examples so we can just isolate these changes in current liability or current asset or whatever, these changes. So this is very contrived, okay? Your company has $100,000 in expenses that were either paid with cash or accounts payable, okay? And we're going to assume that there's zero revenue, okay? So this is our income statement here in both cases, okay? So this is kind of, this negative 100,000 is going to be the starting point in our adjusting, okay? And there's two scenarios here. In this first scenario, our account payable, you can see here, is unchanged. The beginning and ending are the same. In this scenario, we had the same beginning balance, but the ending balance decreased by 13,000, okay? So the first question I'm going to ask, and you should all be comfortable with this, is what do we need to have in this accounts payable to make this happen? What is this question mark? Yeah, Scott. 75,000. Good. Okay. And this 75,000 of accounts payable is related to what? How do we pay accounts payable off? When you pay your PG&E bill, right? They send you a bill, you have an account payable. What are you going to give PG&E to pay it off? Cash. Right? So this is going to be the same as this orange, $75,000 of cash. Okay? And this we're okay with. This 100,000 had this 75,000. These two are related. This and this are related because in this case we paid 75,000 with accounts payable, and this 25,000 we paid with cash. So that's already in cash. Do we agree with that? That 25,000? Because we just paid off those expenses straight up with cash. Okay? So now we agree that this 75,000 in cash is here. Okay? Okay, so let's just do the other side. So now what do we need here? 73,000. This and this are related. This and this are related. Right? Okay, so in this case, we had cash going out of 100,000. Right? And you would have had some starting balance, right? You can't have a credit balance for cash, but I'm just trying to illustrate the change in cash, right? So this could have been $1 million, and now our balance is 900K. I just want to show you guys the change, okay? Because we'll have the beginning and ending balances, but I just want to show you how the change is kind of calculated. So we're just going to have $100,000 decrease in cash. Do we agree with that? In this case? And in this case, what is the decrease here? What is my total credits to cash? 73,000 plus 40,000. What is it? 113. Okay, so how do I reconcile net income to my cash flow? Because now I know that my cash decreased by 100,000. My net income is negative 100,000. Do I need to make any adjustments to this? No, right? What I'm saying when I did this is that the net income is negative 100, but my cash flow, which again, we see here, we said that this was 75,000. We know that the total decrease in cash is 100,000 also. So this requires zero adjustment. What about this? We just saw that this was 73K and our total was 113K. So we need to adjust this, right? We need to negatively adjust this by 13,000 to get to this decrease. Agree? Okay, so now it's 113,000. So now we have the respective cash flows. This was negative 100,000 and this was negative 113,000. And they correspond to this cash, right? This is really what we care about. And the way that it happened is like, look, this AP is unchanged. There's no change in this, and therefore there's no adjustment to net income that we needed because this account payable did not change. This account payable was 25,000. What did we say here? This was 73,000. And so we basically decreased the accounts payable by 13. And that's exactly the size of the adjustment. Okay, and as we saw here, if you look in this, decrease in current liability is a negative adjustment to cash, which is what we had to do. Okay, now there's a couple ways you can kind of square this in your mind. You can think about it like this. In this case, our beginning and ending balance did not change, and we exactly paid whatever accounts payable came in during the period, we exactly paid that with cash. So there's no adjustment. In this case, we had 73,000. So not only did we pay this, we paid an extra 13,000 to kind of pay off old debts. So that cash flow is extra cash from prior kind of things that, prior debts that we had. So that's why it's a negative adjustment. We can't just look at what happened in this period. Now that's not exactly right, because this ending balance is probably going to be mostly from here, because this 73K was probably paying off most of this or all of it. And then this ending balance is actually from here, right? But again, we're just looking at the change. The change is really what is going to help us think about the cash flow. Again, the structure of this statement of cash flows, the operating section, is you start off with this net income. Now you're going to adjust it. So you would say adjustment for decrease in AP is negative 13K because it went down 13,000. And so now you just do this and you have negative 113,000. And that is how much cash flow. Remember, we had 73K here. So when we add this up, it's negative 113. So that was what changed in this period. We did have a cash outflows of 113,000. So we started with this number and we adjusted it, and we now exactly know how much cash went out. And again, in this case, we had 75,000 here. We had a decrease of 100K. We needed to do no adjustment to this. It's already negative 100K. Okay, yeah, and I know it's going to take you some time to really be comfortable with this. It's not obvious, okay, but it does work. Most people don't really look at the adjustments too closely. They just look at the cash flow, like the end product. But I think it's important to understand what's going on. There is information in the changes in these accounts. There is information there. Now let's look at some other scenarios. So this is another contrived example. Now this only worked, again, because it was very contrived. We had no revenue and we only had this expense, okay? That's why it worked. As we're going to see in the real world, you're going to have like 5-7 lines of adjustments that how did inventory change, how did accounts payable change, how did accounts receivable change, and the net of all that is going to be the adjustment. Okay, so in this example, it's very simplified because I just want to show you that this works. Okay, so now let's look at the other side where we have $2 million in revenue during the year and no expenses. So now we're just going to look at the other side where the current asset changes. The net income on the income statement is 2 million. So this is our starting point in our kind of analysis of cash flow. We're going to take the net income of 2 million and we're going to now adjust it. And there's different scenarios here of what happened to accounts receivable. So in this first scenario, accounts receivable is 2.3 million, okay? The ending balance. So the first question is, if accounts receivable increased by 2 million, right? Because it went from 300,000 to 2.3 million, how much cash was collected? There is 0 accounts receivable collected. And therefore, how much cash was collected? No one paid off their account receivable. That's what that 0 means, right? Yeah. So how much cash did I bring in if no one paid anything off? 0, yeah. We should have 0 net income here. Or sorry, we have net income of 2 million, but we should have 0 cash flow. Do we agree with that? Because no one paid. We have no expenses. Our net income is 2 million. But we didn't bring in any cash flow because all of our sales, all 2 million of that revenue was from accounts receivable. And we collected no money. Okay, so how do we adjust net income? what is the adjustment going to be? So we start off with net income, 2 million. How do I get to my operating cash flow? How much was my operating cash flow? We just said it. 0. So how should I adjust my net income? If I do 2.3 million, then I will have a negative 300,000. It's only the change. Okay? I went from 300,000 to 2.3, which is a change of 2 million. That is my negative adjustment. Okay, so this is going to be just negative 2 million. And that will give me to my 0 cash flow. Okay, so now let's do another one. Again, same beginning balance. My ending balance is now different, 800,000. How much did I collect? 1,500,000. So my AR increased, but it didn't increase as much as this first scenario. Okay. So how much do I need to adjust net income? So again, we start with 2 million net income, and we're saying that $1.5 million was collected from this total, right? So this should be 1.5 million. So how much should I adjust it by? Negative 500K, which is exactly the change. Okay. But you have to remember, for current asset, an increase is a negative adjustment. Okay. We saw here that an increase or a decrease in accounts payable is a negative adjustment. An increase in accounts payable would have been a positive adjustment. I mean, if you want to go from first principles, you'll do this kind of thing where you'll kind of see how much cash flow came in. Really, I mean, if you memorize this, you'll get the answer right, but it's coming from what we're doing right now. Okay, you'd have to go through this analysis to see the cash flows to derive this kind of breakdown. But it's basically this analysis we're doing. That's how these the directionality of this it works. Okay, so let's do this one. Ending AR is 300,000, so it's unchanged. Okay, so how much cash came in? 2 million. Do I need to do any adjustment to net income? Because remember, my net income is 2 million. No adjustment, right? Now, again, this 2 million and this are not like the amounts are the same, but this 2 million is including collections from here and from here. Okay, so conceptually, to think about how the adjustment works, you can just think about it like, okay, well, I had 2 million in credit sales and I collected 2 million. So I don't need to adjust my net income for the period. But really, this 2 million is total from this. And probably this ending balance is the amount is the same, but the customers are going to be different. They're going to be probably from the sales in this most current period. Okay, so I think just conceptually understand that. Yes, the amounts are the same and you're just looking at the change, but the details, who owes you money at the beginning of the year versus the end, is different. Okay, and then this last one, where our accounts receivable is reduced. How much cash did we collect? 2.2 million, right? Okay, so we saw a decrease. Okay, so to go from net income of 2.2 million, we need to do a positive adjustment to cash for the decrease in the current asset. I'm hoping conceptually you understand that using the changes in the current assets and current liabilities, it does relate to reconciling back to cash. Okay, now I'm going to show you guys a real statement of cash flow, and it's like very complicated. Okay, there's like 7, 8 different adjustments, but they're essentially doing each of these in isolation. And when you net everything together, it does get you back to cash flow.